Hi, I'm Evan Su. Welcome to the Capital Summit. Be happy to moderating our panel today. We have a real powerhouse group of guests here in terms of the intersection of, I guess you could say, almost the traditional world in many aspects, and Web3, which is the way to expand the ecosystem at this stage, right? We've gotten plenty of people in-house, but the question is, how do you bring that next loop out? We have Neil from Dawn Network, Andrena, and they're doing one of the most interesting DeFi projects that I've heard of, which is essentially bringing the sort of almost like the power model of like sharing that power production for like solar cells, but they're doing it for internet, which is a fascinating project. You guys just finished a fabulous round B, Polychain, over 50 million in funding. So really successful project. Securitize is something we followed for a long time, to the backbone of just bringing all things tokenized on the platform, full broker dealer. They've got in-house fund admin. These are things that really matter to the traditional finance folks. And then we just chatted yesterday with Zach here from Grayscale. Oh, yeah, it's nice to see you. We always say Grayscale is, I've seen this yesterday. I asked Zach, is it okay if I brag on you? Grayscale is the one that sued the SEC and won. So it's like, when you beat Gensler at his own game, you got my respect. And myself, I'm Evan from Gamma Prime. We are a sort of a hub for secondaries. You probably know us from our events. We are consistently the biggest side event at the entire Token 2049, at Hong Kong, Abu Dhabi Finance Week, Hong Kong Consensus, and we were the biggest one here as well. We just had our event yesterday. We had 85,000 people stream it online. So, and about 1,000 people come in person. So if you haven't come checked us out yet, we are usually the biggest footprint, except for Consensus itself. So, all right. I love bragging on our guests, especially when you have like such a powerhouse group. So now we're several years into on-chain fund wrappers, no funds, Securitize, Stack. From where you guys sit, what's the actual milestone that the market should really be tracking? Because people talk about AUM, number of issuers, secondary trading volume, first regulated 1940 Act fund. What is it that you guys are looking at to sort of gauge the progress of this industry? And feel free to go in any order.
Yeah, I can. This is something I'm very passionate about. And again, thanks for the intros and thanks for hosting this. I think that the metric needs to be utility. I think for a long time, we've focused a lot on, we have some AUM, we have some of these products, we've seen the success of funds as a backing asset for stablecoins. There's no shortage of supply. There's a lot of different institutions that want to tokenize all sorts of types of products, but what we still have not really cracked yet across the crypto ecosystem is utility. We need to give institutions and individuals incentive to hold these assets on chain, and in order to do that, you have to give them, like I said, financial incentive to do so.
How is this? Good. I would say that I kind of view it that the answer changes depends on where on the risk curve you're looking at. So I think in our case, as we try to bring telecom assets on chain, we're operating in a very unique space where wireless technology is kind of just shrinking the unit of participation. You don't need to build a meaningful telecom network, you don't need to spend hundreds of millions of dollars. And so if you're in a world where you can spend $10,000 to build a little location, and that actually is spinning off real cash flow that you can then bring on chain, it's a unique opportunity that is enabled by the technology innovation combined with the type of capital you have access to on an internet capital market. And so what I kind of look for are the opportunities where you have this intersection between a traditional capital market gap that that on-chain capital markets are good at solving for, combined with interesting yield opportunities that allow people to exceed the opportunities they can get elsewhere in TradFi. And so I think that's the interesting fusion that think we're starting to see more of. And obviously, like a good example I always like to point to is USD-AI, right? They've taken advantage of a capital market hole, and then people that are looking for access to a very specific type of yield. So I'd say you can kind of quantify it based on the types of yield and the scale of the yield that you can find, but more importantly, the ones that are actually assessed as actually filling a real capital market hole.
Great. I'd love to share some thoughts on this topic. So, of course, fund wrappers are a very important part of what we do. Grayscale is the largest fund management business in crypto in the world, and fund wrappers have been an important part of the nature of our innovation over time. So Grayscale launched the very first Bitcoin vehicle as a security, original GBTC product all the way back in 2013. So that was an early form of fund wrapper access in the crypto industry. Of course, the business, as you were saying, Evan, has moved on very much to the ETFs today. That has been by far the most popular fund wrapper structure for our investors today. And that, of course, is an off-chain structure, bringing a TradFi wrapper to crypto. But it solves all kinds of challenges for investors, which is why it's been so popular. It solves challenges around liquidity, custody, how you do your taxes, how you do your estate planning. All of these things are solved in the single wrapper, and that's why they've been incredibly popular. And so the ETF is still a very core part of our business today. Your question was about, when do we know it's real? When do we know kind of on-chain asset management is something further? I do have a kind of specific idea in mind, something that we're looking out for, which is when are our clients, our institutional scale clients, ready to take in tokenized assets or tokenized funds in a wallet? And that is not the case today. The financial system is about connecting saving and investment, or people that have capital to lend and people that need to borrow capital. We can tokenize assets, but if you don't also bring the capital on chain through institutional wallet infrastructure, it's a little bit pointless. So you need to see Morgan Stanley, you need to see Wells Fargo, the big institutional players have a wallet infrastructure that they can actually invest in tokenized funds. So our view has been that the ETFs are still going to be a dominant growth vehicle for crypto fund management for a few more years, and then we're not quite ready to see the big institutional players invest directly on chain with their own wallet infrastructure. That's absolutely the next stage. Securitize, one of the players driving that forward. But our perspective would be it's still pretty early, and you should expect the ETFs to see a lot of continued growth and maybe a few years out before we have a really fully articulated institutional wallet infrastructure and that capital coming on chain.
And to that question, do you feel like the major unlock that justifies that is kind of making composability approachable to these institutions? Because I think the question is, why would I bother with all this infrastructure if I can just have somebody else do it for me and it's just like a wrapper for the exposure I get on chain? But the only angle that I can find is if you can convince these guys to do cool stuff like looping, yield trading, all of that kind of stuff. But I think that's also a little bit of a different sell.
There are a lot of layers, and I think that's a great question. What is the thing that motivates institutions to want to own on-chain assets? I think looping may be a little bit further out the risk spectrum would be my own take, but I do think that there will be unique things about on-chain finance that ultimately get people there. Maybe some of it is just as simple as moving risk on the weekend. It could be something as simple as that. My own pet theory, which Evan has heard me say before, my own pet theory is that there will be unique assets that are only available on-chain because companies are not just going to tokenize their stock, they are going to issue tokens as a distinct part of their capital structure, and to own those assets, you have to actually have a way to buy them on-chain. So the different routes, but there will be things that drive people to own on-chain assets. I agree with your broader point that it has to be something unique that they don't already have already.
Yeah, this question of push versus pull. And you're not going to push an institution online, but there could be pull, right? There could be like, well, I can't get that anywhere else. Weekend trading is a great example. I swore Bitcoin was going to have one of those professional gaps on over this weekend, as we're breaking through 80,000. And then people are going to come in the next day like, I can only trade futures. What happened? It's like, I needed the weekend trade. So I think there's two ways to view this idea of bringing more traditional finance and Web3 together. One is to bring the traditional investors to Web3, so this is essentially what Grayscale does. And I think where I want to go next is the other direction, which is how do you bring Web3 to the traditional investor, and that's really what Securitize is really focused on. And so, you know, this is kind of a specious argument, but we've heard this before, that institutions go, why would you tokenize a T-bill? It's just the same thing, but harder, right? I can really tell you what I think about that, but I wanted to hear what you guys think in terms of, you know, what else do you get by sort of going on chain in terms of, you know, we'll just start with T-bills, but then also what are the other products that you start seeing, that you see potential for, like you're saying, Neil, which is it's starting to bring something more than what is already there. But we're talking about the RWA direction. So.
Yeah, I think the focus needs to be on what crypto's core value proposition is, at least from my perspective, which is distribution. We've shown, exhibited for the last several years, that we're able to distribute and share products cheaply, efficiently to the corners of the globe very, very quickly. And so being able to tap into that and then bring individuals products that perhaps they wouldn't ordinarily have access to, I think is the real unlock here. And I think it doesn't have to be super complicated. So in my role at Securitize, I work daily with DeFi protocols and help them figure out, all right, what are the different regulatory obligations that Securitize has, because we're registered as a transfer agent, we have a broker-dealer license, we have a registered ATS, I mean, we do everything by the book in that regard, and that's not something that a lot of these DeFi protocols are necessarily accustomed to, right? And so I mean, I like the idea of looping. I think that it's something that a lot of the DeFi teams understand. I don't think the institutional investors necessarily are like super keen to do that, at least right out of the gate. But I think that what that points out is there's this communication gap that I feel really, I mean, it's fun to be able to be the one that's kind of translating across these two completely different worlds. But I would love to see very simple strategies. I think one thing that I think about a lot is, across the global south, you know, access to a lot of high quality products it's not possible for a lot of individuals. And what if we were able to tokenize an ETF, or maybe it's something like an S&P 500 ETF, where an individual could post it as collateral, and then a vault strategy would automatically redeploy stablecoins for additional liquidity. So they're getting exposure to the underlying ETF while also getting additional yield on top, right? So it's very simple products like this. I think we also need to be more creative in terms of how we distribute these. There are tons of small local exchanges that really know their own regions very well that we don't talk about. I mean, we talk about like the Binance, Bybit, Coinbase, Robinhood, et cetera. But there are a lot of other smaller exchanges that know their communities and understand the products that they want.
Yeah, when people say it's just the same as T-bills, but with extra steps, I'm like, yeah, talk to the rest of the world, right? Like, how do you go and buy these things if you are not in America or like, you know, Dubai or like the Far East or Europe, right? And that's the vast majority of people, and they're, you know, they need the fractionalization, they need the ability to buy small amounts, they need the ability to, you know, to route it through the internet instead of routing it through a prime broker, because who's going to open an account for you, right?
I maybe add one thing to this topic. I love the point about distribution. You know, we're in the business of helping investors, put capital to work in crypto tokens. How do you know which project to invest in? And I think the different network architectures differ partly on this question of distribution. You know, something like a Canton, for example, institution-centric network that provides privacy by default. It looks more similar to how the financial system is structured today, and that has some advantages. But open architecture networks like Ethereum or Solana, they may have a distribution reach advantage. And I think this will be one of the interesting questions on tokenization is how does that leadership evolve over time? I do think that open architecture networks benefit from that distribution advantage. Ultimately, I think they have more upside in the tokenization vision, but they have some work to do maybe on privacy tooling.
I mean, I could ramble a little bit, but maybe I'll say something intelligent later on. Let's keep going.
Sounds good. And I also, I'll ramble a little bit. I think one of the things that for a lot of the purists that come from the Web3 world, all this discussions of broker-dealers and like all this licensing, sometimes people are like, why bother, right? Like, didn't we build this to get outside of that? And what I always tell people is, blockchain is really good at some things. If you want an immutable ledger that's transparent, like, that's great, right? It's been like hardened. But FTX and Terra Luna and Anchor Protocol all happened on chain. It didn't stop those things, right? But there's actually tools for that. It's all the Web 2 stuff, right? It's things like having a fund administrator, which would actually have, segregation of accounts. Imagine that. So a lot of these problems, it's not the first time these things have come up, and they've been solved in like traditional finance. So what we're looking for is a merger, right? To have the best between the two worlds, and that's why we really like what you guys are working on with Securitize as well as Grayscale. You guys are in that space where you're like, look, you can meet halfway without destroying the ethos that Web3 is built on. I'd like to go through a couple of specific questions. Neil, I'd like to start with you. And anybody can respond to these, of course. But so you guys are tokenizing effectively what's physical infrastructure, but the cash flow, right, of it on Solana. And from a fund wrapper lens, what are the structures you put around DePIN cash flows? And tell us a little bit about how that might be different from what's needed for things like tokenized credit or equity. Like, is it the same plumbing, so to speak?
Yeah, the plumbing is identical in terms of like there's like always like a direct analog for how you think of one or the other. Like in our case, like obviously you have, vault infrastructure, you have like NAV reporting, right? All of these things are common things that exist in traditional fund infrastructure, but I would argue that the barrier is, or the bar is a little bit higher in terms of what you need to really be able to prove for on-chain capital markets, right? And I think that is really exemplified with how we handle proof of reserves. And specifically in our case, like the objective is like, hey, I'm putting money and that's going to use to finance a telecom asset. How do I know that this thing is real, right? And when you are operating in a retail basis, that trust is kind of one of the most important things that you really have to go deep on. And so in our case, we take a little bit of a higher bar here of demonstrating with a combination of proofs, audits, construction drawings, all that stuff, that this is like a real physical asset, and then allowing people to introspect on the cash flows as early in the process as possible. Everything from it being allocated to a project to it being deployed, how it gets deployed, how an infrastructure engineer comes over there and gives their stamp of approval. And what's kind of interesting about this entire process is that in order to build the trust, we've simultaneously been approaching this from solving the problem of like, how do you actually sell an asset that nobody has ever seen before? And I think if you can find a way to bundle that and answer that question together, it comes with a very unique prong. So I think this is just kind of like one of the many ways that I view crypto has been such a powerful lens for infrastructure and capital markets. It's kind of like, why go to space, right? By solving these very hard problems, you unlock a lot of really cool features that unlock a combination of liquidity, expansion, all of that kind of stuff. So I think we've taken that level of rigor to it, which I'm very excited to bring live on a bunch of stuff.
I think that's one of the fascinating things about Dawn is that it's actually a financial product as well, right? And that's really the relevance to the panel, which is, yes, it's based on DePIN internet, but how, before blockchain, how could you have brought something like this to a wider public?
And the answer is that it's very difficult to, right? Like if you look at like how we have done our capital raising experience and just as we've tried to grow, one of the things that we've come up to as we've reached a certain size is that in order to grow, you need to have the type of asset that people want to finance, which is typically $100 million, $200 million for a telecom project, right? But we're entering a world where that is not the future of what telecom looks like. And the easiest mental analog I always give, and if you've heard me speak, you've heard this a bajillion times, is it's very similar to that of like what solar panels have went through, right? Solar panels were made in 1954. They started getting their strides over the past 20 years. And it really allowed you to say, hey, we don't need a giant power plant anymore. We can just have a micro infrastructure installation that then provides that same functionality just distributed. And it ended up becoming a better solution, but more importantly is you needed a capital market that realized, hey, we need to finance these small things rather than these big things. And if you don't have that capital market, like what the hell are you supposed to do?
You needed the capital market to be symmetrical in terms of the fractionalization, the distribution.
Correct.
And blockchain's ideal for that.
Yeah.
Yeah, just one quick point on this. I think in traditional finance, we do have something that kind of looks like this. It's called the structured products market, where you can take any kind of cash flow and turn it into any kind of output. But to the point that you both have been making, it really works at massive scale. Of course, the commercial mortgage market, the residential mortgage market, auto loans, credit card receivables, those things can be essentially tokenized, to use our terminology, and put into a bond wrapper. But one of the things that's exciting about crypto is that long tail of assets. Things that are any unique product can be use smart contract infrastructure to create a similar outcome for investors.
Yes, and then to add to that, and this kind of ties to the previous question, the real challenge that I think every one of these long tail assets has to demonstrate, at least as we play in this capital market, at least is the case in our scenario, is how do you create liquidity on a fundamentally illiquid asset, right? And I think that is kind of the unique strength of where capital formation of crypto plays, is because ultimately, in order to be able to allocate risk across the ecosystem in the way that investors are ultimately looking for, you need to kind of have these point-wise market solutions that you can bootstrap, but that's what crypto is really good for. So I would argue that it's kind of like this nice match made in heaven where people just like to experiment and do a bunch of different stuff, and you can leverage that to be able to build these solutions to handle these liquidity issues, which ultimately just is a good way for bringing new types of investors to different types of asset classes on a completely different ecosystem.
So we're running short on time. I'm going to skip to the last one. And just briefly, if you had an asset manager, they were like, okay, I want to allocate something in the 100 billion range. What should we tokenize and how? And what would be the first concrete product would you tell them, okay, this is a great place to go, where you see that sort of potential? And where do you think you would say, don't do that?
Yeah, I mean, I think it depends on where they want to distribute the asset, right? But I think just based on what I've seen across DeFi, the liquidity infrastructure for a lot of the products that Securitize tokenize, and we're in the business of tokenizing securities, highly regulated. I think you need to have an asset that has high enough structural yield to be compelling, that you can run looping strategies, or you can run carry trades or borrow against and redeploy assets. But then you also need liquidity. You can't have, it's very difficult to create liquid markets for an asset that is liquid, say, monthly or quarterly, or even less liquid than that, right? So I would say if there's some sort of product that you could bring, and there's a lot of these, but and we might have some up our sleeve soon, but that's in the like 6 to 7% range. That's maybe like T+2, T+1, ideally. I think a lot of DeFi protocols would be very excited for that.
I mean, $100 billion is a big number in crypto, 4x the tokenized assets today. So maybe I'll just say an outside example. I would say build a euro-denominated stablecoin. That's something that could definitely be $100 billion, and there's not enough depth there. So if somebody's putting that much capital to work, I would say maybe a yuan or a euro-denominated stablecoin. I think there's definitely a $100 billion market at least for something like that.
I would actually focus on kind of on the liquidity side of stuff, because I think we've just been having to face that problem so substantially. I would focus on building infrastructure that allows duration risk to be paired accordingly with various types of investors. And I think if you're in a scenario where you're not thinking on a quarterly basis, or you're more thinking on a year-long basis, if you can find a way to use your long duration lens to be able to solve liquidity issues, buy stuff at a discount at a dynamically priced environment, that I think is like a huge unlock for how you bring these assets on chain, and you can virtually touch every single asset.
And I'll give a thought as well. I think another way to sort of slice this is you bring it into the institutional side, right? So what are the products that people would want to bring over? Just give an example. Right now, we see a lot of activity on Gamma Prime for pre-IPO secondaries. This seems to be a really hot thing. So, when you have a block of Anthropic or something like that for $50 million, sometimes it'll be like, we want one buyer. Well, that really limits your universe. But if you can bring that into an SPC, a special purpose vehicle, you tokenize that, you warehouse it, you provide some yield for the buyer, and then you can parcel out segments of that, now you're actually opening up to much wider groups of buyers. And depends on how deep you want to go. You can go stop at accredited, but you can go all the way to rest of the world. Imagine that. So now you're giving people access to something that really was only in the realm of, ultra high net worth, pre-billionaire types of people, and you're using infrastructure of blockchain to achieve it. With that, I'm going to wrap it up. Thank you guys so much, and please give our panel a round of applause.